Good afternoon, everyone. We'll just wait for a few more seconds for everyone to come in for this informative, interactive webinar that we have set for you for today. One of the housekeeping items, this is a recorded webinar. So in case if you have to step out, answer a phone call, don't worry, all participants will be receiving today's presentation along with the recording from today's webinar. Also, this is a good opportunity for you to introduce yourself, what type of business you have, what industry you're in. So that throughout today's presentation, my colleague Jose Monte and I will be more than happy to answer those questions for you. Okay. In addition, I want to tell you for today's webinar, which is Small Business Grants and Financing, what you need to know. Once again, my name is Jesus Padilla. I am the Assistant Director here at the Florida SBDC at FIU, along with my colleague Jose Monte. He is our Access to Capital Consultant. Jose, would you like to introduce yourself, what is your banking experience, and how you're able to assist with small businesses in regards of their pursuit for access to capital?
Thank you, Jesus, and good afternoon, everyone that's attending. I'm a 30-year banking veteran here in South Florida, and during that time, I've managed areas in the commercial banking areas, whether it's corporate real estate, commercial real estate, small business banking, commercial loans, CNI. So obviously, I'm here to kind of give you my guidance and information on what you need to know, how to approach you're a prospective lender, whether it's a traditional lender like a bank or a community-based lenders. There's many different types of lenders, and kind of give you the insights as to what you need to know, how to prepare, what they're looking for, so you have a good idea on having a loan discussion with your lender eventually.
Perfect. Thank you, Jose. And on top of that, I do see a lot of familiar faces, so I just want to welcome you back to one of our webinars. And if this is your first time, don't worry. We're here to guide you, to give you the additional tools for in your toolbox so that your business will be successful. And if you have any questions, I strongly encourage you to put them in the Q&A or throughout the chat. So that either Jose or I will be able to answer those questions for you. So who we are, what we do, we are the 2023 National SBDC of the Year. We have a team of specialized consultants to assist you at no cost. If it's access to capital, business planning, operations and strategies, international growth, even starting up your business, we have a specialized consultants that can assist you, once again, at no cost. How is that possible? We are a resource partner from the U.S. Small Business Administration to provide the one-on-one business consulting, training, and information. Two small businesses are physically located here in Miami-Dade, Monroe County. Now, if your business is in the state of Florida, but not in Miami-Dade or Monroe County, I will be more than happy to connect you with your local SBDC. So I have my email address in the chat. So shoot me an email. I'll be more than happy to connect you with your local SBDC. Now, if your business is located outside of the state of Florida, please send me an email, and I'm more than happy to connect you with your local SBDC that is closest to you. Across the entire country, there's over 1,000 SBDCs. So there's one in your neighborhood that will be able to assist you and enhance the conversation from the tools and resources that you are receiving from today's presentation. Since the center started in 2014, we have worked closely with over 7,800 small businesses and counting. That has resulted over 119,000 hours of consulting. But most importantly, look, one tidbit, we're approaching closely to $500 million in capital access. So that's either through grants, disaster loans, 504 loans, so traditional, non-traditional routes, investments, owner equities. So that is one of the sole purposes as to how we're here to assist you, once again, at no cost, to achieve those business goals and dreams. What is BizGap? This is some of our past projects that we have done throughout Miami-Dade County, through the targeted commercial corridors here in downtown Miami, and also with city partnerships as such, the city of North Miami Beach. What is BizGap? BizGap, it is the Business Growth and Acceleration Program. It is an initiative that the Florida SBDC at FIU has run since 2016. It provides the hyper-local consulting, training, and outreach to small businesses in targeted commercial corridors and communities. Additionally, this project is to provide an additional tool for the toolkit for communities and entrepreneurs who are looking to better assist their businesses with startup assistance and business growth. Okay, perfect. Okay, that's not a problem in regards of businesses located in Collier County. Shoot me an email and I'll be more than happy to connect you with my counterpart as I will make that virtual introduction and I'll push the needle. Some of the outcomes after the partnerships with the multiple communities, we have canvassed, gone door to door. What is the heartbeat? What is the pulse of the small businesses in those areas? But at the same time, we provided the workshops and consulting to over 300 small businesses as well. So overall, we have worked closely with 700 small businesses in canvassing, trainings, and consulting that has resulted multiple impacts throughout the community if it's job supported, created, access to capital, government contracting, and increasing revenues as well. The BizCap project for Congressional District 27 is funded by grants with the Small Business Administration. The Florida's 27th Congressional District, it covers city of Miami, Key Biscayne, Coral Gables, runs through Kendall down to Cutler Bay. Since the 2019 census, over 86,000 small businesses are established in Congressional District 27. What are the objectives? It is focused on the three core activities. It is the training, the outreach, the door-to-door canvassing, along with the business consulting and the data mapping and surveys of the small businesses located in Congressional District 27. Our goal, it is to work with over 1,000 small businesses in this calendar year. That includes assisting in consulting and trainings and workshops as such you're present here today. So once again, my name is Jesus Padilla. I am the Assistant Director here at the Florida SBDC at FIU, along with my colleague Jose Monte, and we'll be discussing more in depth of the small business grants and financing, what you need to know, the different options, as no two businesses, no two industries are the same. So we'll be able to triage to see which is the best strategic approach for your pursuit for capital needs. So we'll be discussing the three key objectives. One of the objectives is to discuss the different stages of businesses, of your business. Now, in the chat, tell me what stage of business are you? Are you a startup, an emerging business, an established business? So that we have a good pulse in regards of today's presentation. Followed by how financing comes in to the start and grow the business ventures and the key terms to remember. That helps you to have the vocabulary, the language of the accountant, the language of a banker, so that you're able to understand what the conversation is taking place. Secondly, to discuss the continuum of small business capital, the different outlets to get capital, and the different access points on the continuum. Lastly, the specific organizations for potential small business financing and the grants to grow or start your business. Okay, perfect. So I see a lot of startups. Perfect. That's amazing. Okay. So before I proceed, I just have a question. What is your why for the business? Why have you pursued this business journey or venture? I myself, I am I have the entrepreneur spirit. I have multiple side hustles in the e-commerce realm. My why, it is pretty much I like to take my wife on fancy vacation at the end of the year. That is my why, based on me having the opportunity to, one, provide a service and of the products that I have for someone that definitely needs it. But at the same time, it is to create the legacy and have the work-life balance so I could take my vacations with my wife. That is my why. So perfect. Yep. Financial freedom, building a legacy, being your own boss, and absolutely. But at the same time, being your own boss, your clients are also your bosses as well. So in business for 10 years, perfect. Yep. Manage your time. Absolutely. That's always the conundrum, in other words, of the work-life balance, because you're the chief everything officer. Okay, person. Absolutely. Yep. Determine your destiny. Absolutely. I love it. Perfect. So this is what we'll be talking about, the different business ventures, the entrepreneurial, focus on building and selling the business, growth of the business for preempts profits, alternative financing, the lifestyle. This is where the majority of where everyone has mentioned in the chat is building the legacy for you or your family, reliable profits, stability, and obtaining the traditional financing. So your overachieving goals will drive the business strategy. So this is where we're in the 3 stages of business. So from the conversation, I've seen a lot of more startup and established businesses. As such, I saw one of over 10 years. Congratulations, and definitely we would love to know what are some tricks in the trade that that you could definitely become like a mentor or guide some of our colleagues in today's presentation that are in the startup phase. But in the pre-venture, they're not yet in business, exploring the business feasibility. But then the startup is in business for less than 3 years, focusing on growing and employment and revenues. And last but not least, the established businesses that have been in business for over 3 years, demonstrate significant revenues over an extended period of time, and always looking for the continuous growth, creating the different strategies in the next phase of the business venture. Absolutely. Yes, I completely agree. Always looking for new revenue streams. Absolutely. And by financing your business idea before you launch the business or go into a new market, always analyze, calculate those expenses that determines if it's going to be a brick and mortar, a service, or an online-based business. Depending on your business category, start up that list of those key and anticipated expenses when having to launch your business, or at the same time expand your business. This can be including the office space, the inventory, the equipment, the licensing, the insurance, the salaries. Estimate how much of these expenses will cost, break them up if they're going to be a one-time expense, monthly expenses, and you should calculate at least 1 year of those monthly expenses, but project them out for 3 to 5 years, as this will definitely help and carry the conversation in the development of the business plan. Jose, when you're working with your clients in regards, Jose, I'm trying to expand my business or to start my business, I need capital. I need as much capital as possible. Is it ideal that the clients that you work with have like a realistic number that is attainable based on their capacity and the capability of them to obtain the debt and also repay the debt as well with the bankers?
Correct. And there's 2 ways to look at this. If we're talking a startup, and by a startup, remember our category has that under 3 years. If you're a startup and you've been in business for 2 months, 3 months, that's a startup. Obviously, you're in the most difficult phase when it comes to obtaining financing or capital from a business loan standpoint. Doesn't mean you cannot get a loan on a personal level, leveraging some of your personal assets or your personal credit. But it's very difficult for the business that started 2 months ago to approach a lender because you're unproven. You don't know if you could have had 1 or 2 good months, and maybe the business is cyclical, and maybe the next 3 months is bad. So lenders like to see a pattern of a trend. So remember, a startup, but they like to see at least a couple of years. Now, if you've been in business and you've got a year, 2 years, 3 years, you're in a very good phase. Obviously, lenders, you're able to prove how the business is done for the last couple of years. Hopefully, that trend shows that sales are trending up. When you start a business, obviously you start slow, and the business starts as you gain more traction, more market share, more the consumers are more aware of your business. Obviously, the sales are going up, and obviously you're showing profits. Now, again, usually small businesses do not have collateral, so they've got to start with a small business. You got to start with a small business loan. But again, there's got to be repayment. Remember, the lenders are not charity. Lenders are in the business of lending money, collecting it, and re-lending. So this is very different than grants. There's got to be repayment capacity somewhere. Now, if the business has limited repayment capacity, but the sponsorship could be very strong, you may have good liquidity. Yeah, you may have a lot of cash flow to get the business going because you planned it out right and you've got other assets or stuff. So that's also very helpful um, to have when you're starting the business. But it all depends how the business is showing. But loans are repayment based. You know, there's got to be somewhere where the lender can sit down and see the likelihood of this loan to be repaid. Same thing. Look at a credit card. Apply for a credit card. It's what do? They run your credit score. That's their key to see what the repayment likelihood is. You have bad credit, the likelihood is bad. Good credit, the likelihood is good. With lenders, it's the same thing. It's got to be what's in black and white. What is the repayment? What does your tax return show? What does your bank statement show? So it's based on black and white.
Thank you, Jose. One of the key benefits of the SBA is that they have a lot of resource, a lot of information that you could definitely do like a lot of plug and plays. One of them, it is a fillable spreadsheet that can be used as a template. So you're able to start calculating your startup costs, also your financial projections, your balance sheet, your income statements. So like that, it helps you to plug them in your business plan. But at the same time, have them as your supporting documents if you want to present them to a lender, a business partner, an investor. So like that, everything is concrete in a one-page document, and you're able to have it for your records as well. Now, in terms of small business grants, always be aware of the scams. If it's too good to be true, it most likely will be a scam. But federal government does not offer free money or grants to individuals for personal or business needs. But small business grants that are available are traditionally given by community foundations, local governments, and nonprofits. So definitely encourage you to visit your local municipality or county, as there's the mom and pop grants or any nonprofit grant opportunities that could definitely enhance as there's a revolving cycle of the application process. So definitely encourage you to do the due diligence, do research, but at the same time, your local governments is one of the best routes to do so. Yes, and the good thing is that there's an excellent question. Yes, everyone is going to be receiving the presentation along with the links. So pretty much, I'm giving you the full course meal so that everyone's able to get the desserts, and the desserts is all the links, all the different organizations that you could definitely could connect with as well.
Yeah,
It's a
just a
great
quick side
question.
note. It
Go for
states
it.
obviously that the federal government does not offer free money. The only time the federal government comes in offering anything similar to free money is in a catastrophe. Like when we had in COVID, they were offering the PPP through the banking system, and the government at the end became free money if you followed certain rules. But barring a disaster of sorts like a COVID, that is correct. The government is not handing out free money.
Perfect. The small business grants that are available can be an annual basis, a one-time or one-off program. So by always being consistent, being up to date with all the information like that, you'll be able to one successfully apply and be one of the first ones because sometimes it's a first come first serve. Also be aware that many cohort-based training programs offer grants upon completing the program or winning a final pitch presentation. So check the program announcements when applying because at the same time they want you to you're not just getting free money just for the sake of free money, but what value are you providing for the growth of the purpose of obtaining those grants as well. Then in the debt financing and equity financing, the debt financing means borrowing money that must be repaid over time, usually with interest, while the equity financing is raising money in exchange for a share of the ownership of the business, becoming business partners. Jose, while you're working with your clients, they always say, I want to work with an investor, but I don't know what's my business valuation. What are some areas that you're able to have like some pretty much the lingo or preparation for the small business while working with potential investors?
Yeah, I mean, like obviously we're talking an equity financing. Uh, if you're running, we're talking, you own a restaurant, you own a typical small business. Equity financing can be somewhat challenging. You've got to find, short of what we call friends and family. Friends and family is obviously can provide equity financing, but that's a different realm. I mean, looking at an arm's length investor. Arm's length investor, you need to have a business plan. You need to have a a standout service or product in the marketplace that is unique and that has potential for growth. And that's usually what attracts investors. They want to come in and they're willing to gamble and provide money because they see a long-term potential. But again, you're giving up part of your business. If you're able to attract an investor, you're giving up part of your business for that share of money. And then there's also other areas regarding, how involved is that investor. So everything's got to be very, very, very well spoken, negotiated up front from that standpoint. A small business, unless you've created equity financing it can be challenging. Now, debt financing is obviously your standard traditional. You're getting a loan from a lending source, whether it's traditional, like a bank, a credit union, or non-traditional, from CDFIs, from fintech companies, from many lending sources that are out there. And obviously, they don't take a share. They're financing based on a return for them, which is usually the interest and a predetermined term, interest rate, and upfront fees to close the loan. So that's a different kind. Equity financing, again, you've got to have something attractive to bring in the investor. It's a Shark Tank. So obviously it's very competitive, and you've got to have something that stands out to attract investor, and have a business plan which highlights everything, how the business started, what the management is. That obviously you know what you're doing, and you're bringing something new to this business, and how the business can grow, because they're putting money in your hands and allowing you to run it. So there's got to be a very good comfort level that there's upside in their investment.
Yes, and then Jose, in regards of the equity financing, if you choose the equity financing route, is it typical to give up a majority of your business?
That is all negotiable. Nothing is set. Nothing is set in stone. Now you're talking equity financing for startups is very difficult, unless again you've got something so unique, a product, a service, and you built a better mousetrap that's attractive to somebody. Somebody can see the vision of what you're bringing, of what you've created. A business has been around for 10 years. Obviously, you're proven. The business has good financials. It all depends. If you're looking for, let's say, for capital to buy a facility, to go from literally from an e-commerce to now you're going to go brick and mortar as well. You want to buy a place, you want to rent a place, you need to buy more machinery to double or triple your product, because you've got too much demand. So there could be investors out there, but it is all negotiable. Obviously, it's very simple. The more you're looking to raise, the more you're going to have to give away. But it also depends how much you're looking for relative to the value of the business. The business is selling $1 million and you're looking for 500,000. Obviously you're asking for a huge chunk of what the business is potentially worth or generating on an annual basis. If you're selling $1 million and looking for 20,000, obviously that's very small relative. So anything that you'd be giving up should be small. And obviously, remember, everything is negotiable, and how much control that investor has or doesn't have is all part of that process. But equity financing, you've got to be very careful with, because you're giving up you're giving up some ownership in the business for a little bit of money, and it might be better perhaps if you can obtain financing. Yeah, you might be, there's a financing cost. Whereas when you get an equity investor, he's giving you the money. There's no interest per se. You're just giving up a percentage ownership in the business. In financing, maybe it's better to pay an interest, but you still control. You own 100% of the business. And if it takes off, it is all yours. The profit at the end of the day is all yours. You've got your payment to the lender, and that's it. But it's your business. It just depends your need. What your business model is, what you're selling, what you're doing, what your product, how much money you need, how long you've been in business. So there's many factors but that are involved. But to answer your question, no, there's no set. I'm asking for 100,000. I need to give up 50%. It is all negotiable, and it should be done very carefully.
Yeah, because at the same time, it could be royalties or it could be after X period of time, once the business started generating X amount of dollars. So it
Yeah,
could be like if Jose wants to provide equity financing of $5,000, or and then once the conditions is I get 5% of the business, once you start generating over $1 million. So in return, Jose will get $50,000. So it could
right.
be the long game.
Correct. There's
So
many forms to do it. Maybe the investor might say, "I'm providing you 100,000, and you're selling a product. From every product you sell, you're going to give me $2, $5 until I get my loan back, until I get my investment back. And after that, you give me 50 cents on every item you sell for the next 10 years or in perpetuity. So it depends. Everything is negotiable. Just got to make sure that you're in control. You're not giving up an unequal share for that investment.
and then in regards of the what's a good starting return on investment, for it all varies because at the same time, like if I'm a potential investor, I want to invest in everything. What yields the most return investment as quick as possible. So the burn rate is quickly. So we have a consultant that definitely does equity investments, and but it has to be well established businesses, have a skin in the game. I could be completely wrong, but I think he mentioned something about 20x. That is the return investment. But like I said, that is his wheelhouse, so I don't want to speak on his behalf. But shoot me an email, and I'll be more than happy to connect you or ask or answer that question on your behalf as well. Okay, I have a question right here, Jose. And I pretty much know the answer in the next few slides, but I just want to bring it up. My LLC was created last June. I have an EIN, but nothing else. Where do I start? I'm ready to apply for grants and loans to start marketing the business. What as an access capital consultant, what are one of the first steps to do?
Yeah, I mean, obviously, if you've got no sales, approaching a lender is not going to be for you at this moment in time. Um, again, from the business standpoint, you may have to rely on your personal assets, and I know some business owners, and speaking to them, are reluctant. They don't want to get the business, they don't want to get personally involved, their credit and what have you, to get the business up and running. But it's the chicken or the egg. I mean, if you cannot get a loan from the business, the business is unproven, you just started, you've got no sales, you've got nothing. Approaching a lender is challenging. I mean, there's nothing to base repayment on for any small business loan. So perhaps you get a personal loan. You go that route until the business takes off, and then you pay the personal loan off, and you move into the business loan side. Um, so that's sort of the way to approach it. It just depends if you're a pre-venture to startup, meaning you've got no sales, no assets. You've got an idea, a product, and you want to launch it, but you haven't. But you're set up. I mean, having an EIN number and an LLC is fantastic. You also have to have a business account opened at a bank, because any sales you do should not run through your personal account, should be paid and run through your business bank account. That's from the lending side. On the grant side, again, most grants, typically grants for a brand new startup with no sales that is started, um, um, those are also rare. There's typically grants, and remember, the grantor makes the rules. I want to lend to a business that's in this particular area in Miami, a particular gender, particular business sector, particular product. They make the rules of what they are. Some of them are general. Some of them, if you're in business for a year and you're located in Dade County, you're eligible to apply. So you apply quickly because the grants get taken up. So it depends, but there are some grants out there, that come from time to time for startups. So obviously those are the ones, but that's not commonplace. Most grants are here to help businesses that are already up and running and established, and want to help them perhaps bridge a gap, keep them going, keep them operating, help them perhaps grow a little bit. So that's really the motive of what grants are for. But when you've got no sales and really haven't started, I mean, the fact that you have an LLC and EIN, it doesn't mean you're in business. It means that you've got the name has been registered, at Sunbiz, you've got a tax ID, that you need for the IRS. You got to open a business bank account. So you've got, you've got the A, B, and C ready, and you've got to start selling. So, financing your financing may not be lender financing or grant financing, depending on how new you are. And again, there come other sources. You got friends and family. You've got other sources that you've got to look at. A credit card financing. You might have to bootstrap yourself or pledge other assets to get the business up and running.
But at the same time, we also have different consultants in the realm of marketing, strategic operations that can assist you to take those calculated risks. Because at the same time, we don't want you to be spending money in areas that is not return investment for you. So definitely shoot me an email, and we'll be able to help you with the organic approach of marketing your new startup so that you're able to have a good cash flow to reinvest and put back money into the business to continue to expand it as well. In regards of how do you find these kind of grants, at the end of the presentation, there are some links of some grant opportunities, websites, and links. In regards of how to find those kind of, does it make sense to hire a grant writer? It varies. Some of them are self-explanatory, some are not. But definitely, you could touch base with us, and we'll be able to assist you with the grant application to cross the T's and dot the I's. In regards of making prototypes and get pre-orders in writing, and the lenders will have to look at that. In regards of term sheets, Jose, I have pre-orders in writing. I already have accounts, payables and receivables. Do the lenders look at that as well?
Yes, if you got orders, and aside from lenders, there's also non-traditional lenders and the fintech companies. But yes, if you've got orders, if you've got agreements, if you've got a contract, if you're supplying a particular product to a retailer, to a wholesaler, depending what your product is. But if you have orders, yes, that's valuable. Because remember, the lender wants to know, okay, how is this business going to make money? Well, I've got the orders. I've got this product, and I've got buyers. I'm selling, I'm selling cakes to Publix. So Publix is buying my cakes. So I've got orders. That's valuable. That's very valuable. So yes, orders are, and there's lenders out there outside of banks. And again, banks are unique because banks are highly regulated. So banks, aside from mortgage, want to know that you've been in business for a particular time. They want to look at your business tax returns. They want to look at your personal tax returns, personal financial statements, business bank statements, your personal statements. So they want to see the whole gamut of what your background is for this business because they're regulated and they've got to follow their credit policy. So it's a very involved due diligence process for the typical traditional bank, credit union, regulated lender. But there's other lenders that don't need to follow that because they're not regulated, like the fintechs or community-based. So if you've got contracts and you've got orders, a lot of times these lenders, what they look at is they want to see what are your monthly sales. So if you've got sales, and obviously the way that they verify those sales, they're not going to verify them so much by here's my accounts receivable aging, here's my inventory listing. If you've got an agreement, you got a black and white agreement with a Publix, for example, to sell my cakes, that has value because that's a signed agreement document. Other than that, some of these non-traditional lenders will look. They'll ask for your business bank statements, and they'll see what's coming into the bank because sales go into your business bank statement. If you're getting in cash and not putting it in, that doesn't help you. And the lender obviously cannot rely upon what you say you're selling or putting in your pocket. They look literally at black and white what they can document. So business bank statements, if you've got money coming in, yes, they can look at that and come up with a small business loan, depending on what your business bank statements show for the last 90 days.
And then in regards of the debt financing, I love it. Everyone's asking questions. Continue putting it in the chat, and like that in between some slides, I'll be able to chime in as well. In the debt financing, this is where the lending institution does not gain ownership interest in the business. This is where the loans are often secured by the company's assets or the borrower's personal guarantees. It could be used to cover construction, equipment financing, and working capital. There's various types of loans. There is the real estate loan, lines of credit, leasehold improvements, and term loans. So no two businesses, no two industries are the same. So it's best to touch base with Jose and our other access to capital consultants to see which is the best route for you. In regards, Jose, I have a question. If I take out a business line of credit and show good repayment habits, will it help me when I'm ready to apply for loans? And the answer will be yes, because it has the character that you have good habits, and it shows the your character that you're able to showcase with the bigger financial institutions, that you're able to repay those loans to get the ball rolling. Correct? Do you want to elaborate a little bit more?
Yeah, I mean that's correct. If you already have a business loan, you're referring a business loan or a personal loan. You got a business loan, line of credit, absolutely. You go to another bank and if you want to grow, or remember, lenders like to grow with business. So if you start with a small line of credit of 25,000 in year one, the business is taking off, and your lender will know. The lender will know because if you have the bank statements, the bank accounts, he'll see the activity running to the account, assuming it's with the same bank. But yes, absolutely, it helps you grow. Make sure the business is growing more. That lender wants to lend you more. Wants to increase your line to 50,000, 100,000. It all depends how the business is doing. Trust me, lenders are in the business to lend money, so they want to grow with you. If you grow, they love to grow with you. They don't want to lose your business to another bank. Again, but you've got to be able to support the growth, and the repayment is there.
And then this is where we're able to start focusing on the short-term and long-term goal financing. Short-term, it could be forms of an overdraft, a letter of credit, a short-term loan, usually for less than 1 year. Think of it like a small bridge loan. Short-term financings does have a higher interest rate and don't fulfill the long-term investment needs as what you're seeking. While the long-term financing can be from of a long-term or leasing of over a year, equipment can be costly and can be taken in terms the long-term lease with the business eventually buying it out as having the cash flow. Long-term financing provides the stability, but the total interest paid over time is higher as it is longer period. So think of it as a mortgage. It's either a one-stop shop or a mortgage of X amount of time frame in regards of the heavy machineries, construction buildings, or higher working capital. Jose, with you on long-term financing and short-term financing, are there like any additional examples that you could provide?
I mean, short-term financing, and again, the bulk of these products are really geared to businesses that are already operating and established. These are not, you didn't start last month. Let's say all of a sudden you got an offer where you can buy more inventory at a particularly great price. Something happened, you're able to buy an extra container of shoes that you're selling at half the price that you normally buy it. A lot of times, a lender will give you a short-term loan, maybe secured by that collateral, by UCC1 on a short-term basis. And yes, it's usually a little higher because it's a short turnaround loan. And obviously it's short term because you're not going to sell the shoes in 10 years. You're going to get them in, sell them, get paid and pay the line down or pay the loan back, within a short term, depending on how it is. And obviously long-term financing, that's for typically long-term assets. And the rate is usually better. It's usually fixed for a long period of time. But then you're talking, you're buying a commercial condo for your business, if you're buying a warehouse, you're buying heavy machinery, heavy equipment, depending what your business are. That's typically long term because the life of that collateral is long term, and the repayment is long term. It's not inventory you're selling. It's machinery, equipment that's allowing you to provide your service or your product. So that it's a longer repayment period, and lenders like it because it's long-term assets, it's fixed assets. It's from their standpoint, it can't disappear. The business does bad, the equipment is somewhere to be found. On the short-term business, obviously UCC typically unsecured, so there's higher risk involved for the lender.
And then Jose, correct me if I'm wrong, in regards of the long-term or short-term, what type of financing for an existing businesses, let me rephrase it. What type of financing for an existing business that's looking to purchase an existing running business, in this case, a restaurant? What is the best source of financing? It will fall under, I'm assuming, towards long-term financing because it's our acquisitions, correct?
Correct. That's a long-term financing. I can tell you the SBA the SBA has they love to finance purchases of businesses. Um, Again, you know, you're gonna have to have whoever's buying the business. You're obviously, if you're buying a restaurant, that your background is in the restaurant business, or you have another restaurant and you're combining two different restaurants, or you're combining different locations. So the lender's gonna want to make sure that one, obviously, that you have the background of the business that you're looking to acquire. But yes, there's lenders out there. The SBA in particular likes to, in general, they like to finance businesses that are buying businesses, that obviously helps them to grow and to double in size or what have you. Now, I can tell you from experience, a restaurant in the traditional lending arena, and I mean banks, restaurants are a four-letter word. Traditional banks do not like to finance restaurants, acquisition, growth, line of credit, you name it. Traditional banks, um, barring barring very few. If you're a staple of Miami, you're La Carreta, if you're a particular well-known established restaurant in Miami, that's different. You've been in town for 20 years, you've got multiple locations, that's different. You're getting a McDonald's franchise, that is different. But if this is Jose's sandwich shop, restaurants are very, very reluctant um, on restaurant financing because it's extremely risky. And I can tell you personally, I've lent to restaurants in 30 years, and I'm not sure that a single one turned out well. We do it because there's different circumstances why we end up lending to restaurants, but I can tell you that a single one has turned out well. Restaurants is it's one of the riskiest, obviously, and very labor-intensive business. And whatever you loan, if the restaurant business goes bad, there's no collateral. So banks really shy away from restaurant lending. So you may have to go to other sources outside of traditional when it comes to banks. But if you're buying again, the SBA is one that they like to finance businesses that are buying businesses.
Okay, thank you, Jose. And then in the equity financing, this is where you're raising money in exchange for the shares of the ownership of the business. The most common source of equity financing comes from family, friends, and business acquaintances. But be aware that less than 1% of companies seeking venture capital actually gets funded. So it is what Jose was saying. What is the wow factor? That's where you're able to enhance the value proposition, how you're able to fulfill the needs and wants of that marketplace, the problem that you're solving. So like how Jose was saying, like the Shark Tank method, but once again, you have to get the interest of the respected venture capitalist. So we're gonna go over the continuum of the small business financing, where each individual is located in regards of the access to capital financing. Some it could be bootstrapping in terms of just saving up money on a weekly basis, on a yearly basis, that you have a good $5,000 that you're able to start your business. The small business grants that are in the community. How about the mission-based lenders that are out there? The SBA microloans and the traditional loans like the 504 and the 7A loans, the family and friends route. The traditional commercial loans, the crowdfunding, the peer-to-peers, the angel investors, and the venture capitalists. So there's different conundrums of continuums of obtaining capital. But at the same time, you have to think organically and growing based on which is the route that's best suited for you. So once again, it's bootstrapping, the small business grants, the mission-based lenders, the SBA microloans, and the traditional loans, along with the commercial loans, family and friends, crowdfunding, peer-to-peer, angel investors, and venture capitalists and equity. Jose, I have two questions for you. One, so how do you start if you're not operating yet? Is family and friends a good route for you? It seems like every other option is proof of sales.
That's correct. And I mean, obviously, there's many businesses, even businesses that we're talking about today. Give you an example. Jeff Bezos, he's got $1 trillion company. He started off with credit card debt. So a lot of businesses start. They don't have the sales, but they have an idea, and they think their ideas is great, and they've got a market. They know how to sell it to them, and they know how to generate a money or a service that maybe is missing in the environment. bootstrap. Unfortunately, you bootstrap friends and family. Now, friends and family is great. Typically, you're getting money. You're getting money. I don't want to say money for nothing, but you're getting basically money. Um, and whatever you negotiate with them, look, if it takes off, I'll pay you back in 5 years. It could be have no terms. Now, obviously, you owe a relative or a family member some money. So that could create other issues. Depending whether they're giving you the money and look, here's the money, take it and run, and I hope it goes well, or they're giving you the money and they expect that money to be repaid with interest. So it all depends your discussion that you have or your relationship with your relatives or friends and family to get that money. But personal credit cards, people get loans with personal credit card companies. If you've got good credit, I can tell you credit card companies out there like American Express, Citibank, Chase, almost all of them offer personal loans. You have to have good credit history, but they'll offer you personal loans, 20,000, 25,000, and usually very attractive terms. Sometimes much better than you'll find in a business loan. Because they're lending it to you personally, not to a business. So they have a name and a face, and it's your personal credit. So chances are you have a higher tendency to repay that loan because it's your personal credit. So now these lenders do offer small loans to consumers. It's to you individually, but they're out there. You may want to start that route until you get it up and running. I've heard the response, I don't want to start. And I go, well, if I've got a good idea and a good business, I mean, I don't care where the money comes from. If I don't start the business, I've got nothing. So if I take it from my personal funds and friends and family or credit cards or what have you, that's a price of getting the business off the ground up and running. Step two, you can transfer it, you pay it off, the business takes off, and fantastic. It easily gets paid off and becomes a business now banking relationship with a lender.
And that will be coming towards the next question, because I know I had some questions about lines of credit. Because sometimes some clients, they get a line of credit because they have a project that they have to fulfill. So once they complete the project, that's when they get paid. So having a steady cash flow of the line of credit definitely helps as those safety nets until you're able to cash flow yourself, that you don't need a line of credit. Now you're self-funding the business operations on a continuous basis. Then this will part with a second question. Jose, can I get a loan based on executed construction contracts?
If you're talking now you're a developer, you're a general contractor. If you're talking about what was the question again exactly? How was it worded?
Yeah, can I get a loan based on executed construction contracts?
Construction contracts. Okay. A construction financing is what the lenders call project financing. If I'm building a house and I'm building a
And
house,
his general contractor is a GC.
It's a GC. Typically, unless you are a very large bonded contractor, banks don't necessarily finance those contracts because you're paid by the lender. If there's a construction loan out there, or you're getting it, or you're building the loan for Mr. X, obviously Mr. X has to have the money to pay you on a monthly basis. Construction loans are paid on a monthly basis as work is completed. Lenders do not go and give you those funds because you got a contract and there's a construction loan. That construction loan funds every month. Whoever the general contractor, if you're a subcontractor or a general contractor, if you put in 10 nails at the end of that month, that construction loan funds for 10 nails. Usually they fund for 9 nails. They hold the nail back till the end of the project. So they'll fund you for 9 nails, and that's how you get paid by the general contractor. If you're a subcontractor, if you're a general contractor, every month you get paid by the bank loan. That's project financing. So so taking that contract to a lender, they're going to say, well, obviously, it's not a business loan. Construction loans are very unique because they fund for work in place. An inspector goes out there and makes sure that yes, the roof is on. So now I can fund for the roof. I can submit an invoice to get paid on the roof. Now the plumbing is in. I can get paid based on the plumbing. So that's construction and that's project financing. And having a contract, typically a lender is not going to fund you those monies because what happens is a contractor takes that money and spends it and doesn't put in the plumbing, doesn't put in the roof. There's no control. So that's project financing, and that's done with monthly inspections, with title updates. and that's a totally different set of animals. But that's funded either by the construction loan or it's funded by whoever hired you to build their home. And you have to assume, you have to verify that they have the money to pay you, because obviously you don't want to put in the plumbing or put in the walls, do the CBS, block the foundation. All of a sudden, you're asking for an invoice to get paid, and he says, I don't have the money. So whoever you have a contract with, that you're building a home or a commercial or property, whatever it is, there's got to be either a bank loan involved, or obviously there's capital that you verified to pay you for that. Or you take, or if you're doing it directly with the homeowner, obviously usually you ask for a certain deposit up front, and then you're going to bill him as the work is done. So I guess the answer to your question is no. That those contracts are typically not taken to a lender, and here's I have a contract for $100,000 to build the X amount of work for a particular project, and the bank's going to lend you 80,000 on that. No, that's not how it works.
And then the small business financing can be viewed as a road or a pathway. Once again, no two businesses are the same, no two industries are the same. So there's different points of the continuum depending on the stage of your business, the industry, the business structure, the organizational structure, your credit history, your small business finances, and the different types of capital needs that you're seeking to begin with. But then let's check and review the different points of the continuum of the business financing. So the bootstrapping is the self-funding of the business expenses yourself or via family and friends. The upside is that you can retain the control of the business, but you can take on all the risk. Also talk with a financial advisor not to jeopardize your retirement plans, because oftentimes folks take out their 401k loans or any other life savings to pursue the business venture, but at the same time, we want you to have those calculated risks. Being a small business owner is risky, but we want you to have the conservative calculated risk so that you're not jeopardizing your future plans.
Jesus, before we continue, I just want to clarify on that construction contract. If you've got a contract to build, let's say, a home, you can go to a lender and convert that to a construction loan if there's no construction loan in place. But remember, that loan for the construction loan is going to have to underwrite or approve either you or the person who ultimately is going to buy that home. Because how does it? They're going to convert it to a construction loan, and they're going to give you X amount of money every month until the home is completed. At some point in time, the loan to build that home has to get paid off. Who's the ultimate borrower? It would be whoever you're building it for. It should not be you, because you're a contractor. You don't want to get involved in a loan when you're basically, you're a contractor and you're not the end user of that property or home in this case. So it can be converted to a construction loan, but that should be done by the person who owns the property and who hired you. And it can be converted to a construction loan, and then you get paid every month. So just want to make clear, you as a GC would take it to a bank, it wouldn't make any sense, because at the end, that home is not yours, or that property is not yours. So how does it get paid back? You don't want to be on the hook for a loan when you're the one providing the service.
Along with another option of bootstrapping is to reach out to family and friends. Along those business acquaintances are industry experts that have knowledge in regards of the good, the bad, the ugly of that industry. But thread carefully not to mix your business and personal relationships. Clarify the risk to those potential investors, settle on the fundraising strategy, and document all the transactions. And communicate regularly after the initial investments and work up to more professional investors. With the small business grants, it is the best way to use your time is to research the national, state, and local organizations that providing the grant funding to small businesses. When looking for grants, those who have the best chance of security is based upon your industry, business size, age, and other characteristics. So do not try to be a fisherman and try to catch all the fishes. Just focus on those that identify the best chances for you to obtain those funds. Jose, obviously the county has a lot of grant opportunities, organizations. What is one of the best avenues for folks to to look for is, I'm assuming it's just to get all the documents in order, like their financials, the purpose of the grant opportunities, correct?
Yeah, and remember, grants, as we mentioned before, it's up to whoever's providing the grant. They set up the rules or the requirements. Um, Typically, grants are not based on, they're not, excuse me, they're not performance based. They don't ask that you have X amount of sales or X amount of profits. So that's the good thing about grants in general. There could be some that have other requirements. They usually focus on small businesses. If you're selling $5 million, the grants are probably not going to be for you, and they won't be eligible. But typically, they're not asking for tax returns or financial statements to verify the activity of the business. They may ask for those documents just to verify that you're actually in business and that you do have a tax ID and that you are performing, you are filing tax returns. So they may request certain statements. They may request your business, your some biz documentation that you're verified when the business opened. They may ask for your local business tax receipts, depending what city you're in. If you get a grant from Coral Gables, they may ask for your Coral Gables tax receipts. That obviously you are operating in a particular um, city where the grant is offered. So the grant depends. Some grants again are based on gender, could be based on if you're a minority, if you're a particular business sector. But typically, as long as you're in business for a couple of years, and the other requirements, they are what they are. Again, focus on the ones that you can meet and apply for, and you apply quickly because those grants get subscribed quickly. And if they've got 500,000 and they're handing it out at $5,000 maximum per application, trust me, they get written up very quickly. So obviously, the sooner you apply and you get in the queue in the system, you have a better chance of perhaps getting approval if you meet the eligibility requirements. You got to meet the requirements, what they are, but they're usually requirements that are not burdensome. They're should be easily obtained.
I just have a few questions. Okay, yes. Where can we go to find businesses for sale? Yes, shoot me an email and I'll be more than happy to answer that question for you. Do you have a higher likelihood of securing a larger amount of business loan if you put more than 20% down or minimum threshold?
This is regarding a business acquisition.
It's a separate transaction.
Okay, but likelihood to get a larger loan if you put a down payment. So a down payment signifies you're acquiring something. You're buying a business.
We'll see, or if not, the collateral. Like I think that's more like the SBA route.
Yeah, great. SBA is more the down payment, or even a lender. If you're buying a business, obviously a down payment comes into play. Traditional lenders ask for a higher down payment. SBA has the most generous, smallest down payment for that. But I mean, remember, it's all relative. It's not a larger loan. The loan there has to be a specific loan. You can't walk into a bank and say, how much can I get approved? So if you're buying something or you need a specific amount of money, you have to back up why you need that specific amount. Not just I want $50,000 to grow. No, you got to be able to demonstrate either in the business plan or financials how that $50,000 is going to convert existing sales into more sales, ultimately to more profit. There's got to be a chart that you can show to the lender how why this money is critical to your business. Not just that I want money because I know with money I can grow. Obviously, we know that the more money we have, the more solid we are. But you have to have a specific amount involved. Can you get a larger loan with a bigger down payment? Not necessarily. Typically, the more down payment you are, that brings the loan amount down. If you're buying a business and it costs you 100,000 and you put in 20,000, doesn't mean you can get more than what the business is what the cost is 100,000. So you're looking at 80,000. You're not gonna get 90. So it's all relative. Putting a bigger down doesn't mean that the loan is bigger. If I understand the question correctly.
And then many local organizations offer grants to start or grow small businesses based on their areas. Let's look at some of these type of organizations who may offer small business grants in your area. So first look at Start Local. The first groups, it could be the counties or the city's economic development department. Some of these organizations offer grants or incentives to local businesses. It could be the Business Improvement District. It could be the CRAs, the Downtown Development Authority, and along with the Main Street programs. Some of the community redevelopment agencies, it could be beautification grants as street lighting, signages, painting of the exterior parts of the business, of the brick and mortar. Some of these organizations can provide, once again, facade improvement grants, capital improvements, also other grants targeted towards recruiting or retaining businesses in their respective areas. Now, in the community foundations, there are statewide, regional, and local community foundations that offer those funding of the local projects. While these programs are usually targeted for not-for-profit in the community, there are opportunities for small business financing. So definitely do the research if this opportunity is right for you. This is because these organizations often serve as a conduit for philanthropic efforts in targeting communities, businesses, and nonprofits. Here's a helpful link to identify local community foundations in your area. You could use the Community Foundation Locator on the Council on Foundations website. Now, with the national organizations like FedEx, Barclays, just to name a few, don't forget to add some cohort-based trainings that could offer small business grants upon the completion of the program. So definitely helps you to definitely help you out to get the necessary funds, but at the same time educating yourself of the what's next. You got the funds, you got the grants, what are you going to do with it? The mission-based lenders, they're also known as the CDFIs, which is a Community Development Financial Institutions. These organizations provide affordable financing, training, and support for small businesses. Funding of these organizations often mix federal and state resources and private funding, but at the same time, to identify the local CDFIs in your area, you could research on federal CDFI fund website on the link below. But at the same time, we also work with our local CDFIs here in Miami-Dade County. So if you're interested for that introduction, by all means, shoot me an email. Jose will be able to make that introduction. Like that carries the conversation, what's the intended usage, how much capital. You'll be able to assist you to get the funds for the business growth. Then the SBA helps the small businesses access funding in backing the loans from the commercial lenders and CDFIs. The SBA does not lend the funds. Just a full disclosure from the get-go, as oftentimes we get calls, it's like, I want an SBA loan. But the SBA does not lend loans. They back the loans from the commercial lenders and the CDFIs. It reduces the risk of the lenders and lowers down the payments for the borrowers, lower the term rates and fees, and provides continuous support on the loans. Now, Jose, I had a question here in the chat. It was in regards of any prepayment penalties if I paid the loan for long-term financing. Any prepaid penalties on long-term financing. It could be traditional, commercial, or SBA loans.
Yeah, and that's a negotiable a negotiable feature. Historically, where you see prepayment penalties is you're talking commercial real estate, long-term financing, and typically you see prepays when you're getting an extremely low rate. So what happens is the bank does certain financial hedging to give you a certain interest rate on that loan. So they want to make sure that they're going to get that return on your loan for X amount of time. So typically you have a prepayment, but outside of that, in small business lending, prepays are not the norm. You shouldn't see a prepay on a small business loan. Even a long-term loan, it depends how large of a loan we're talking. But typically prepay penalties, that's a more complex feature that you see in much larger loans and with larger financial institutions. It depends on the transaction, but no, I would not be worried about a prepay. And that's negotiable, by the way. That's not written in stone.
Okay, I have one right here. how do banks or any lender would accept intent to award contracts? The contract is valued up to $500,000. The catch, it is a work order contract, and there are 13 other businesses that have the same contract.
You've got a contract to provide work, service, or product, and you're asked, how does a lender approach that contract?
So,
Is that the question?
yeah, if you want to elaborate more in the chat, by all means, you could do so. Okay. And then, what type of financial information are lenders asking for businesses in pursuing a line of credit?
And remember, in pursuing a line of credit, you've got to be a business that has a cyclical kind of a product or service. I mean, lines of credit are highly scrutinized by the lenders. So you got to make sure that your business is one that a line of credit suits. Line of credit is suitable because that's short-term financing. They're gonna ask you for a personal financial statement. They're gonna ask for your personal tax returns for the last 2 years. This is of the owners. If there's one owner, two owners, it's the same thing. Personal financial statement and personal tax returns on each owner. Usually, if they own more than 20%, but lenders can change their policy from time to time depending on what it requires a guarantor. You're going to ask for the business tax returns, minimum 2 to 3 years. And again, the lenders want to see this because they want to see a pattern. They want to see a pattern of how the business is done the last 2 to 3 years. They're going to ask for the business bank statements. They may ask for 3 months to 6 months. They want to see that obviously what the activity is coming in. So they're going to ask for all this information depending on what the business is. If it's a business that provides a service, they're going to provide, obviously, you want to see a resume on you, your background, why are you an expertise in this particular business? If you're selling a product, they're going to want to see an inventory. That's for an inventory listing, accounts receivable aging. So they want to see how the handling of the business is. How much inventory you're carrying, and there is what's the time frame between the time you get the inventory, it's converted to a sale, and the money comes back into the business. So they're going to ask for all this information to come up with a comfort level on the line of credit application you're looking for. Obviously, they're going to run your credit on all the owners. They'll do a background check online. This is all standard due diligence that the banker or lender will do today. So documentation, you've got to have it in place. The longer you've been in business, the easier it is because obviously there's more information for them to look at. And again, if you're already banking with somebody, you've been in business, aside from looking at many different lending sources, one lending source that I would certainly be on my short list is the bank where you're currently banking. Where do you maintain your bank accounts? Because they can pull up your bank account information and see it quickly. They can see your history there, and you're already a client. So I would certainly talk to them. Sometimes, it means nothing. Some of these big banks, sometimes, you're just in a deposit an account, and they're really tough on small business loans. But I would certainly have a conversation with them. And if not, perhaps maybe a community bank might be more in order for you. It depends.
And then the microloans, it proceeds to be used for working capital, inventory, furniture, or equipment, but not for paying any existing debts or purchasing additional real estate. Then with the 7A loans, which is one of the primary business loan programs for small businesses, it guarantees to lenders that allow them to provide financial help for small businesses, and it can be used for acquiring, refinancing, improving real estate or buildings, purchasing current business debt, purchasing the equipment, fixtures, supplies, along with the multiple purpose loans, including all the above with changes of ownership, of like buying out of one of the business partners. The maximum loan amount for 7A is $5 million. And to be eligible, you must be operating in business, operate for a profit, must be located in the US, be small under the SBA size requirements, but not to be any type of ineligible business, like anything in the marijuana, adult entertainment, and Bitcoins, anything along those sorts, and not to be able to obtain the desired credit on reasonable terms from non-federal, non-state, and non-local government sources. And most importantly, be creditworthy, and demonstrate a reasonable ability to repay the loan. Because this is one loan that you should not be defaulting or being late on. This is where we're able to visit the SBA Lender Match tool. So right there, it provides who are the best lenders to assist you with the actual needs of the business based on your particular profile. With the 504 loans, it provides a long-term fixed rate financing for those major fixed assets, as which we discussed, that promotes the business growth and job creation. They're available through the CDCs, community-based partners, and the maximum amount is 5.5 million. This is where you could use it for existing business, new facilities, long-term machinery and equipment with a useful remaining life of minimum of 10 years. Think long-term. And have a tangible net worth of 15 million and have an average net income of less than 5 million after federal income taxes of 2 years of preceding your application. So you could be eligible for the 504 loan. The same opportunity. This is where we're able to find the CDCs that will be able to help you to obtain necessary funds in that regard. And this is not the loan application for the SBA 504 7As. Depending on the amount that you're seeking, it would often take at least, and Jose, you could correct me if I'm wrong, like at least a good 9 to 15 months to get everything organized, with working with the accountants, with the lenders, with the businesses, to get all the documents lined up in order. Is that correct, or is it a little bit shorter?
Well, it depends. SBA loans, they're time consuming, but it's a traditional bank loan with an SBA portion of it. Again, it all depends how organized you are. Do you have your tax returns? Are you on extension? Do you have financial statements? If you don't have financial statement, that's not a problem. Most lenders on their website have a blank form you can download and complete. If not, the internet has generic financial statement forms. But no, it's a matter of how quickly you are to have all your things. You call your accountant. If you have an account, get your 2 or 3 years tax returns, get your personal tax returns, get your business bank statements. You can probably get them online and download them. The more information you have in support of your business and the loan request, the easier it will be. You don't want to walk into a meeting and have the lender, give you a laundry list of what you need. If you walk in with it with a package already, here's my application that I filled out, my personal financial statements, my bank statements, the tax returns. Here's my business plan on the business. Here's the loan that I'm looking for X reason. If it's to buy a property for your business, you need to have, you can do the research online, have a contract reservation. The more information you have in black and white to the lender, the easier it's going to be, and the more interested they're going to be. This is a real deal, and they're going to take a look at it.
Then, Jose, does the SBA have case studies of companies that have successfully applied for and utilized money for success? Yes. You could look at FedEx. One of how they started, they received SBA funds, or Chobani, just to name a few entities. So definitely, the SBA has backed some successful businesses, but when they were starting out, they were able to obtain funds through the SBA. That's the name of some.
As Jesus mentioned, the SBA does not have, they're not a so-called lender. There's no offices where you can look up and say, here's an SBA loan office. All the SBA loan products are administered and handled through the traditional banking institutions. And almost every bank, without exception, does SBA loans. From any bank here in Dade County, either they have an SBA lending department, or they have a designated loan officer that specializes in doing SBA loans. So that's how it's handled. So, and obviously that's who you talk to, and that's the process. But I guarantee you, wherever you have your business bank accounts, I guarantee you they do SBA loans. They may not be an aggressive SBA lender, but they do offer SBA loan products. And again, when it comes to the SBA, there's lenders all over the United States, and some are more aggressive than others. So it depends. It depends how good you can, how good the support for the loan you're looking. But there's lenders all across the country that you can approach for an SBA loan.
And the reason why we came back on this slide, oh, the reason why I came back on this slide is because of what's the CDC company? It's a certified development company, which is an SBA community-based partner. Okay. And then with the pre-seed funding, this is with family and friends, as what we discussed earlier, for any business, whether early stage or later on, can include the funds from family and friends and business acquaintances. It could range from anywhere from 5,000 to 100,000, but you should clearly define the risk to those potential investors, set up the fundraising strategy, and properly document all transactions. Because after all, if the business does fail, it's still a business transaction, and you don't want Thanksgiving to be really uncomfortable at the dinner table with your family and friends that invested towards your business. At the same route, seek equity financing, whether early stage or later on, can include the pre-seed stage seeking funds from family and friends. Strongly recommended that you have a shareholder or membership agreement that clearly spells out all the relationship terms and conditions. The commercial loans, they're not guaranteed by the SBA, so they're increased risk for the lenders. For this reason, the commercial loans have a shorter repayment plans and a higher interest rate. It could be within 48 months with, I'm just talking right now, 7% interest, or 60 months with 10%. I'm just talking. Just think of it as if buying a car. You finance a car for X amount of time period at this percent interest rate for X amount monthly payments. The upside of the commercial lenders is that you have a variety of financing options, and you only must meet the lender requirements, not the SBA's. So it's the Goldilocks approach. First, contacting what Jose mentioned, the relationship of the lender. Contact the lender that you have the most banking relationship with. The crowdfunding, this is other avenues how to obtain some funds. There are 4 different ways for crowdfunding. It could be donation-based. Donors give money in nothing in return. Equity-based, it's anyone that provides funds in return for shares of the business. Debt-based, it's investors are repaid with interest. And reward-based is those who donate receive the products and services in return for those funds. Some of them, it could be Fundable, Kickstarter, Indigo, Party Round, just to name a few crowdfunding options. And then, Jose, I have a question for you. Is some sort of proof of income required with SBA and commercial loans?
With any lender, if you're talking about the business or personally, with any lender, a proof of income will be your tax returns. Absolutely.
And then the peer-to-peer, this is where it involves sharing your idea with other people in hopes that they will invest in your business. You determine how much you need to borrow, define the purpose of the loan, and this way, if you find any takers, you might have a source of financing of your options. But like I said, at the end of the day, have everything documented, because you don't know whether the hitting surprises that the respected lender might be soliciting. So some websites, it's Prosper, Lending Club, Upstart, just to name a few, and it could range from $1,000 to $50,000. So this could cover the business expenses as such, the working capital, purchasing the agreements. But once again, always review the lending terms and conditions, as some states still have restrictions on the peer-to-peer loans. Now we're approaching the angel investors, the venture capitalists. This is where the business angels are accredited individual investors who seek higher returns with the risk level through private investments and early stage companies. Typically through associations, clubs. The interests of the angel investors are businesses with growth potential, strong management, solid business plan that aids the angels in properly assessing the company's value. Typically, they invest in ventures involved in industries or technologies in which they are personally familiarized. So think of it as, if I'm selling apples, I'm not going to look for investors who only do oranges. So make sure you have to start having the networking opportunities, the connections, the contacts, to make sure that you're able to attract the ideal investors in your business. This is where they're able to finance in early stages, sometimes without customers or generating revenue at all. But the business instead would have a solid business plan and develop a MVP, the minimum viable product, and possesses a strong management team with the industry experience. This definitely provides that you know the good, the bad, the ugly in the industry, but at the same time, you have the know-how in that industry. This is where few businesses seeking angel investments actually secure them. So manage your expectations properly, do your homework, and decide. And if you decide to go this route, just like how it was with Starbucks, they're looking for investors, getting capital. It took them multiple times to them to be successful. So just have a solid business plan is good opportunity for a pitch deck to introduce you to the respected angel investors. The upside of being having the angel investors, they provide the strategic financing at the right time for your growing business. They add unique business experience to booster the support of your team. In addition, they lead you to venture capital investors as you progress in your business development, but the angels maintain their ownership interest. In the venture capitalist route, this is where private equity financing issued by firms or funds for early stage or emerging businesses. The VCs are always looking for high growth potential, as what Jose has been saying, with the number of employees, annual revenue, innovative products or services. Note that if you get equity financing, it may prevent you from obtaining a loan that has any type of personal guarantees or ownership requirements. In exchange for investment funding, investors receive shares of the company and play an active role that the company invested in. You do not repay or put up collateral or worry about interest rates as their own pursuit. It is they own a stake of your business and may make controlling decisions based upon the amount of funds invested. So just be mindful of that and always have to into consideration. So if Jose is my venture capitalist and he has 25% of the business, I need to have consideration of the 25% of his concerns based on the direction of the business. So it cannot be a 50-50 split, but at the same time, you have to have that into consideration. Due to high failure rates, now I know that we talked about this in the chat. This is where the VC investors seek high rates of return for companies which they do see success. With the venture capital, with the SBICs, this is also licensed and regulates over 300 small business investment companies around the country. It provides loans ranging from 250 to 10 million with interest rates between 9 and 16%. And they also invest in businesses in exchange of ownership of the company, which range from $100,000 to $5 million. They typically target the mature, profitable businesses with sufficient cash flow to pay the interest, as each SBIC has their own investment profile for specific industries, geography, company maturity, and types and sizes of those financial offerings. To qualify, you must have 51% of employees and assets in the United States, qualify as a small business, and be an approved industry. So this is where we're coming to the later end of today's presentation, which we have all the different links on we're gonna go with your neighborhood Spider-Man, I would say, like the local small business grants. On the local side, we have Access Helps, which is a really good website that has a lot of grant opportunities that are throughout the county, but also the city of Miami, Miami-Dade County, mom and pop grants, but also the municipal community redevelopment agencies. These are some really good websites and links for you to look for any potential grants on the local side. Now, in the community foundations, there is the Coral Gables Community Foundation, the Miami Foundation, which is Miami Open for Business Loans or Grants, along with the Community Foundation of the Florida Keys, in case if your business is located in the Keys in Monroe County. The national grants, the U.S. Chamber of Commerce, the Women's Nets grants, the FedEx Small Business Grant, and the Fast Break Small Business Grants, just to name a few. With the mission-based lenders, there's a CDFIs, there's Ascendus, the Black Business Investment Fund, the Dade Federal Credit Union, the Florida Export Finance Corp, Miami Pesa Foundation, Partners of Self-Employment, and 10 North Group, which was formed as the Opalaca CDC. So these are great partners that we have actually worked with on a continuous basis, and we'll be more happy to make those introductions and connect you with the appropriate colleagues of ours that could help you out in your pursuit of obtaining capital as well. The SBA lenders, this is where you're able to look for the CDC along with the lender matching. Some top crowdfunding platforms, you could definitely visit the crowdfunding.com, but also NerdWallet has some really good platforms for the peer-to-peer lending. And then for anyone that's looking for angel investors or venture capitalists, definitely encourage you to connect with any of these colleagues of ours that could definitely introduce you, but definitely encourage you to do the due diligence to see which industries they like, and if that fits within your industry, that could be a great match for you. And then last but not least, the CBICs. This is where the investment capitals, the directories, but also Lafayette Square is a really good website to visit to. So if you're interested how we can continue working with you, assisting your business needs, please visit our website, which is bizcap.miami, but also follow us on our social media channels at SBDC at FIU. But definitely encourage you to like and subscribe our YouTube channel, as we have a plethora of a library of recorded webinars that definitely enhances the conversation with our business consultants in the realm of access to capital, business planning, operations and strategies, startup assistance, all the different facets of what a small business entails. We have a specialized consultant that can assist you in those business needs as well. But definitely encourage you to start thinking, what are your 2025 business goals? So this is a good time for you to start thinking what you would like to accomplish next year, so that you have a good head start for the next 5 months. That would be more happy to start implementing those strategies right now. So if you're interested to meet with the business consultants, I'll provide the QR code in the next slide. But if there's any particular questions, please put them in the chat, and I'll be more happy to answer those questions for you. And interested to meet with the business consultants, like I said, this program, the Business Growth and Acceleration Program, is for businesses that are physically located here in Miami-Dade County, especially in Congressional District 27. So if your business is located in Broward County, Orlando, or just like right now, North Carolina, don't worry, shoot me an email. I have your information, but I want to be more than happy to connect you with your local SBDC. Okay. So I want to thank you all and for attending today's webinar. I want to thank Jose, but let me see if I have any questions as well for you, Jose. Okay. Let's see. Okay, pretty much we did. Yes, I am going to share the presentation along with the video recording as well. Okay, Jose, I have one question. Any benefits opening a credit line?
Well, yes. I mean, if you're opening a credit line and you're approved for a credit line, absolutely, you're building credit. So absolutely, it's always easier to jump from an existing credit line relationship to another bank or to a different kind of loan product, because you already have a banking history that's positive. So absolutely.
Okay.
Even if you don't use it, but if you have one, you can maintain it open and use it on and off. Yes, that's a good idea.
So I'm assuming I always get this saying wrong. The best time to get capital is the time that you don't need capital, correct?
That is true. That is true.
Yeah, it's a tongue twister for me.
Remember,
but yeah, so
sometimes lenders have a bad rap. The typical banker gives you the umbrella on a sunny day, and when it starts raining, he asks for the umbrella back. So that's typically how people look at lenders. But no, lenders are out there. They're in the market to lend money, but they're regulated, so they have to follow certain protocols. So, but no, if you can get a loan, and it helps the business, I would certainly get it. It can only help you in the future if you want to jump to another loan. You've got history, and history is very valuable when it comes to in the lending realm.
Perfect. All right. So yeah, so that concludes today's presentation. We pretty much answered every single question. But at the same time, we want to be mindful and respectful. I know that we went over the time, but like I said, it was informative and very engaging, which I definitely love because at the end of the day, it's additional tools for your toolkit. Because at the end goal, my why it is for you to be successful. That is my purpose and the purpose of Jose, and along with the mission here at the Florida SBDC at FIU is to grow your business and create that economic impact in the community. Thank you so much, Samantha, Xavier. But definitely anything that we can do to assist you, you have my email address. We're family, and we'll be looking forward to seeing your next presentation / webinar or consulting session. Thank you all, and enjoy the rest of your afternoon. Take care, everyone.
All right. Take care, everybody.